A fairly dramatic rethink of the Fed underway for 2019. While the markets still see the Fed hiking in December, the number of hikes and the timing for next year now being called into question. Here are the probabilities. December still trading at a 75% probability. Worth noting that that's down from a high of a 90% in that contract. And then June, you see 60%. That looks high, right? Well, guess what? It had been above 50% for March. So it's pushed.
Where is March?
Further.
Did we decide not to have March? We're just going to skip March.
I've only got the ones there. Well, usually I only put up the ones with the 50% probability.
So March is going below 50%?
Below 50%. Not happening in March. The first 50% probability for 2019 is in June. It could be a good month, Tyler. You have to be optimistic. But in any event, the first 50% probability for 2019 is in June. And I had another one there. It had September up near 50%. Not anymore. October is the next highest one for that second rate hike for 2019, just trading at 31%. Over at Evercore ISI, Krishna Guha writes, we think the likelihood of a timeout on rates remains very low, but the likelihood the Fed might at least temporarily slow the pace of its rate hikes from once a quarter to once every 6 months is increasing. What's behind it? Well, market gyrations and recent Fed speak behind this change thinking, with the Fed Chairman Jay Powell now talking about the risks of going too fast and too slow in equal terms. Leads Lou Alexander from Nomura to write, quote, Powell's recent comments suggest a dovish shift in the chair's message. Now, New York Fed President John Williams yesterday, he said we'll likely be raising interest rates somewhat, but it's really in the context of a very strong economy. We're not on a preset course. We'll adjust how we do monetary policy to keep our best to keep this economy going strong with low inflation. So it'll take more than just market gyrations to keep the Fed from its appointed task of hiking. The center of the board still seems committed to bringing the funds rate to neutral. What is that? 2.5% to 3.5%. If the economy weakens, though, it'll likely be more towards the lower end of that range, which means one, maybe two more hikes, but not just the market. You got to bring the data down, too, with it, which, by the way, I know it's hard to remember when the market's down almost 600 points, but the economic data has been super strong.